everybody. It's just 1 minute after 1. It looks like most people who registered are joined. I think maybe just a couple more folks. So I just want to welcome everybody to our webinar today. Today we're going to be talking about updates on the CARES Act and the Paycheck Protection Flexibility Act. I know a lot of people are curious about reporting requirements, and this is crunch time now about thinking about loan forgiveness and how to account for everything. So I am here with my colleagues, Rob Nasso and Margaret Lawley. So I am going to turn it right over to Rob to kick things off. But before I do that, a couple housekeeping items. Everybody here is on automatic mute. So if you have questions for us, please use the chat box. Do it to all panelists, and what we'll do is we will kind of address questions at the end of each session. Rob's going to do session, Margaret's going to do session, and then I'm going to do session. So we'll try and squeeze in as many questions as possible, and then we also have some time buffered in at the end to answer questions. Thank you all for joining. We hope that this is useful for you. And I'm going to turn it over to Rob to kick off.
Okay, good afternoon. Thank you, Kelly. I'm going to just fast forward here to the outline, and basically I'm going to be going over the Paycheck Protection Program. And so for those of you that don't have PPP loans, you can go ahead and multitask and answer your emails, etc., for the next 30 minutes. Or if you're just curious about the program, you certainly listen to everything that I have to say. The next presentation will be on the HHS stimulus funds, which Margaret Lally from our office is going to be going through, and there's really a lot of good stuff in her presentation. So make sure you stay for that. And lastly, the accounting for the CARES funding and PPP funding, Kelly's going to cover, and again, a lot of good information in that. Okay, just a quick timeline. Most of you guys are aware of really just how this all laid out. Basically, the CARES Act was passed on March 27th and allotted $349 billion for PPP. And then shortly, really less than 3 weeks later, ran out of money and SBA stopped accepting applications. Shortly afterwards, it was replenished with PPP 2.0, an additional $310 billion. And probably the biggest change to the program, which was really beneficial and important to everybody, was on June 5th when they passed the PPP Flexibility Act, which extended the covered period from 8 weeks to 24 weeks, acknowledging that the pandemic wasn't going to be this kind of couple-month impact on the economy and companies, and it was going to be a much more long-lasting situation. So so it made sense to go out beyond the 8 weeks to the 24 weeks. June 30th was the final date to apply for PPP funding. That was extended on July 7th to August 8th, and then on August 8th, the application date expired with $134 billion unspent, which was pretty surprising that there was still money out there. I think there definitely was other companies that could have taken advantage of it, but they didn't for whatever reason. The next kind of critical date, which isn't really a hard date, but beginning in September, the banks started accepting forgiveness applications, and never since the last month or two, the applications have been slow going. And I'll talk about that a little bit in a few minutes. Okay, by the numbers, 5.2 million loans, 87% of them were under $150,000. 1.6% of them were over $1 million. Most nursing homes, healthcare organizations fall into that category. I mean, we've had clients that have loans anywhere from $1 million to $5 million in general. We have some kind of larger organizations that have up to $10 million of PPP loans, and so it's obviously been a very beneficial program. $525 billion was loaned in total. $134 billion unspent. The average loan size is $101,000, And the largest sector was the healthcare sector, which received $68 billion of the $525 billion. Okay, the PPP Flexibility Act, just quickly, I mean, and most of this presentation is not going to be, all about covered costs and things like that. We're going to kind of get to the application and kind of the updates and the things that everybody needs to be aware of, currently. But basically, the Flexibility Act extended the covered period from 8 weeks to 24 weeks. Generally covered the periods out to June 30th to December 31st, depending on the timing of when you actually applied for your loan. Importantly, they also removed the restriction or lowered the restriction of how much money needed to be spent on payroll, reduced that from 75% to 60%. There's some additional safe harbors that were included in that, extended the loan period from 2 years to 5 years for if you applied after early June. Extended the deferral of payments from 6 months to the date the forgiveness is determined, which made a lot more sense. Also established a deadline for the forgiveness application of 10 months after the last day of your PPP loan covered period. So you do have plenty of time to submit your forgiveness application. If you don't submit a forgiveness application after 10 months, then the loan's considered a loan and there's no forgiveness. And they also kind of added in the deferral of payroll taxes and clarified that participants or borrowers were actually eligible for that deferral program, even if they did have a PPP loan. Some other things, the FTE exemptions were expanded as part of the PPP Flexibility Act. They added this additional exemption, which covered inability to rehire employees on February 15th, 2020, and an inability to hire similarly qualified employees for unfilled positions on or before the end of the year. And obviously this was because it was very difficult to hire people in many industries that just didn't really want to go back to work given the COVID issues. Probably, one of the most important things with the PPP Flexibility Act was this additional safe harbor. This is Safe Harbor 1, which basically talks about if the borrower is unable to or is able to document an inability to return to the same level of business activity that they were operating at as of February 15th. And it refers to guidelines and regulations that were issued by HHS, CDC, OSHA. This would also cover, state regulations and executive orders that were issued. And essentially, if this particular guidance or these executive orders made it impossible to return to the February 15th level of activity, then an exemption on loan forgiveness would most likely apply. And so basically what this means is that if you can show that because of these executive orders, these restrictions, you were unable to function at the same level of business activity as you did prior to COVID, then essentially you're exempted from the FTE quotient. This is very important, and I think that generally that we feel that most nursing homes may be eligible for that particular safe harbor, but it does come down to documenting those issues. Because we have some nursing homes that certainly qualify for that based on the things that happen to them, and other nursing homes not necessarily so. And this just doesn't cover nursing homes. It covers, really any industry, that was impacted by COVID. A couple focus areas, things to think about. Documentation is really important. Not only in terms of what your lender's gonna require, but also in terms of the attestations that you're making based on the documents that you're submitting. Certainly focusing on maximizing PPP loan forgiveness. The thing that we're working on with a lot of our clients is be aware of multiple funding sources or double dipping. And this particularly applies to organizations that receive grant funding, where that grant funding is supposed to cover expenses that they have. And then in addition to that, they may be receiving HHS funding. as well as, PPP loan forgiveness. And so, it depends on your organization. If you're a nursing home, I'd say generally the double dipping isn't much of an issue. The thing that we would pay attention to, obviously, is HHS funding and making sure that that you're not basically treating the same cost for PPP as covered costs for HHS funding, and I'll get into that a little bit more. Certainly pay attention to the FAQs. The PPP program and HHS funding is something that's constantly changing. Seems like every day there's new updates, there's changes, so you should definitely pay attention to those. Quickly run through the PPP covered costs. Everyone's pretty much aware of this. Obviously, payroll costs is the big item, and there's some exclusions for payrolls or deductions that you take from the gross pay that you pay. People that make over $100,000 need to be adjusted down. The family leave credits, if you've applied to those would have an impact. If you reduced wages by more than 25% for any of your employees, that would reduce your payroll. And then in addition to payroll, you have health insurance premiums, retirement benefits paid, and any state and local taxes that are based on the compensation of your employees. Non-payroll costs are rents, mortgage interest, and utilities. And so this is pretty obvious, what those comprise, and I think most of our clients haven't had a problem, understanding those issues. One thing I do want to mention with the PPP program that seemed a little bit inconsistent but was later clarified is that, that the cost that you can include in your PPP covered cost application, not only include service periods but also amounts that you paid during the covered period. And so, so the covered cost would be what you paid during the covered period, as well as service periods that applied to your covered period. And so I'll go through a quick example for everybody so it becomes a little bit clearer. And so in this case, and this is based on an 8-week covered period, so keep that in mind, which is essentially 2 months. But this particular borrower's covered period started on June 1st and ended on July 26th. And the borrower pays its May and June electricity bill during the covered period. So before the end of July, they have 2 months of electricity that's included in that. And then in addition, they receive their July electricity bill on August 10th. And so essentially that borrower would be able to include the July electricity bill in the covered period. So essentially, and again, they would have to pay that bill within the normal billing cycle that they normally pay. And so essentially they would end up with 3 months of electricity bills included in their covered costs, even though it's really only an 8-week period. So that's kind of a nice benefit. But it's something that you should be aware of if you think you're falling behind in terms of getting all your covered costs covered or your loan fully forgiven. You should pay attention to that as you get towards the end of your covered period and make sure that you accrue those costs and then pay them within the next billing or payable cycle. Not going to spend a lot of time on FTEs, but basically the FAQ is clarified. It's based on a 40-hour work week. We've had clients that say, but I have a 37.5-hour work week. Doesn't matter. You have to use the 40-hour work week, and you'd use that same work week both for your covered period and calculating your FTEs as well as your measurement periods or your reference periods. So you have the option of using the actual 40-hour work week or using the simplified calculation where you treat anyone that works more than 40 hours as 1 FTE and any part-time employee less than 40 hours as a 0.5 FTE. Generally these calculations come out pretty close, not in terms of the number of FTEs, but the relationship of the FTEs during the covered period to the measurement periods. But again, if it benefits you to use the simplified calculation, you should use it, and so we would recommend that everybody calculate it both ways. The 2 reference periods that you're comparing your covered period to would be the 4.5 months in 2019 from February 15th to June 30th, or the first 2 months of 2020. just a quick example of how the FTE quotient works and whether the FTE quotient matters. This is an example. You can see the reference periods that this particular borrower had. They had 120 FTEs in 2019. They had 100 in 2020. They had 90 during their covered period. And so you'd use the lower of the two reference periods. So they'd use the first 2 months of 2020. Essentially, that would be 90 divided by 100. Their FTE quotient would be 90%. And so the way it works is you apply that 90% based on the lower of the covered costs or the loan amount. And so you apply that against their covered costs of $900,000. They would have $810,000 forgiven, and they would have a remaining loan of $190,000. That loan would be, at the time they apply for forgiveness and they receive forgiveness, that loan would start amortizing over generally a 24-month period unless you applied later. And then the interest would be 1% of that amount. So you can see it's fairly straightforward. The whole point of the FTE quotient was to incentivize employers to bring people back and bring everybody back and maintain a full workforce. But obviously with the 24-week period, it becomes less of an issue. So generally we present this when we're consulting with our clients, and it's really kind of two different ways of doing the FTE quotient. It has a material impact on the forgiveness amount. And so initially with the language in the CARES Act, many people felt that the forgiveness worked according to this treatment A column. And so if you look at this column, this is a 24-week period. They received a loan of $1 million. They spent $2 million. And basically the way this calculation works is you would choose the lower of those two amounts. And so you'd apply the 90% against the loan amount. They get $900,000 forgiven, and they'd have a $100,000 loan remaining. And so, this seems kind of strange because they spent $2 million. Why shouldn't they have all of it forgiven? But there's a number of people that interpret the language to mean exactly what that calculation is. I'd say they're in the minority, and most likely I think it's going to be the treatment B, the green headed column, which this follows the forgiveness application. So if you complete everything on the forgiveness application, it works the way it's calculated in treatment B. And so in that case, same facts, but they would actually choose the higher of the two amounts, the loan or the covered costs. So this borrower spent $2 million. They'd apply the FTE quotient to that, comes to $1.8 million. And so since the $1.8 million is higher than their loan amount, they would receive 100% forgiveness. So, many people are saying, well, what am I supposed to do? You're kind of telling me there's two different ways of doing it. I would say you basically treat it according to treatment B. Maybe even confirm that with your lender. But then I would have backup. I'd try to reduce the amount of risk just in case they use treatment A. And there's a number of different strategies that you can do to influence that FTE quotient. And so, again, I would be comfortable with treatment B, but I would have in my back pocket a couple different safe harbors and potentially some other things that I'll talk about in a second. So those safe harbors, what you should have in your back pocket. The number one, safe harbor number one, inability to return a prior level of business activity due to regulatory restrictions. Every industry is impacted by that. Generally, healthcare organizations, I think, are in a pretty good spot. Whether you're a hospital, whether you're a clinic, whether you're a nursing home, most of these organizations I've been talking to, I think they have a really good case for it. I do a lot of work in the nursing home industry, as many of you know, and I think that most nursing homes have a pretty good case for safe harbor number one. And so basically, if you can document this and you feel comfortable with it and you run it by your bank and they say, yeah, that makes sense to me, I think you don't have to worry about the FTE quotient. It doesn't matter at all. Basically, in the calculation, you're able to use 100% FTE quotient, and you may be eligible for using the easy application. Safe Harbor 2 is another option that a number of our clients have done. Basically what this is a restoration of your FTE count by the end of your covered period, or the end or the period up to the point where you submitted your application for forgiveness. And so in that example I had with the 90 and 100, that company, averaged 90, but if they started at 80 and they were able to get it up to 100 by the end of their covered period, that Safe Harbor number 2 might apply, and that would help them, again, with 100% forgiveness. And then lastly, also to have in your back pocket is this FTE reduction exception, where you can add back FTEs for terminations, voluntary leaves and reductions. Again, with healthcare organizations, there were a lot of this going on. And so again, in the example I provided, they were 10 FTEs short. If they were able to go back and identify 10 people that were either terminated or voluntarily left the organization during the covered period, they'd be able to add those FTEs back into their calculation and achieve 100% forgiveness. So a couple things to be aware of is, as I mentioned earlier, everything's constantly changing, and advice that we gave early may not even apply anymore as FAQs have come out and clarified things. Look to having loan forgiveness calculators. A lot of times the banks and attorneys and accountants have those calculators they can share with you. And I think, again, continue to look at the FAQs that come out. I mean, the FAQs keep coming out. I mean, we've had FAQs that came out, as late as, a week or two ago. So the big question that we generally have with most of our clients is, when do we file? And should we file early? Because you can file right now. And so some of those pros for filing early, is if you just want to get it over with, you think you've spent all the money you have to spend, your FTE numbers look good, you're way over the amount that of your loan amount. One reason to maybe file early is your FTEs are starting to drop, and so maybe they were good during the 8-week period, but they dropped since then. You might want to file for the 8-week period if you actually spent all the money, and you would qualify for 100% forgiveness. That's not really a reason, but your bank's ready to accept your application. Some banks have actually established a reservation system where they give you a particular window to apply for your forgiveness application. I wouldn't let that influence you. You have 10 months to apply for the loan. There's no reason to rush into it. So if the bank says this is the week you can apply, I really wouldn't pay any attention to that. Interest is accruing on your loan, not really a good reason. The interest rate's really low, the 1%. I don't think that's really a big issue. Lastly is loan covenants. If you talk to your existing lenders and you have a loan and you think there's a loan covenant issue, this may be something to kind of take a look at. So I wouldn't discount that reason. But some of the advantages for waiting, as I mentioned, is the guidance just hasn't been finalized yet. As I mentioned, things continue to come out pretty much every couple weeks. And generally, there's not really a big benefit. I haven't seen a benefit generally for most of our clients. The third item, just giving you a couple extra weeks. So even if you think you spent all the money, why not be sure? Why not get all 24 weeks in if it doesn't really impact you? The more cost that you spend and the more above the forgiveness amount, I think the better off you are. Number 4 is, I think, very important. I think once you submit your application, it's really not clear whether you're going to be able to change it. So if you have the wrong FTE numbers in there or something, or you don't like how the bank, did it, and you felt that there was additional things you could have done, it might be too late. Number 5, payroll processing reports appear to be incorrectly calculating FTEs and salary reductions of 25% or more. And so, this is really an important thing to kind of take a look at, because, part of the application is the lenders have certain guidelines and things that they can follow and rely on. And so one of the things that's included in with the PPP guidance for lenders is they can rely on payroll processing companies' reports. And so basically it takes them off the hook if you can supply an ADP report, a Paychecks report, or a Paylocity report, and that serves as the basis for your payroll and it serves as a basis for your FTEs. The banks can actually rely on that. And so that's important to them. They'd like to check the box, and say that they received this. But what we're finding is there's errors, there's mistakes in those calculations. And just because the bank it's going to be acceptable to the bank doesn't get you off the hook. You still have to sign the attestations. You have to sign off that everything is accurate. So, even if the ADP is providing you a report that may or may not be correct, you're still the one that's liable for it. So I would take a very close look at those reports. What we found is that the FTEs that they're calculating with the simplified method doesn't appear to be correct, where they take somebody who worked part-time maybe for 1 week, and they counted that person as a half of FTE during the whole covered period, which seems to be incorrect. And also they've made salary reductions based on hourly employees. So if you have someone that works 10 hours 1 week and then they work 5 hours the next week, that's not considered a 25% reduction as long as you paid them the same hourly rate or an hourly rate that wasn't 25% less than it was before. And a lot of the payroll reports are treating that as though it's a 25% reduction. So make sure you take a look at those reports because it's really important. And lastly, and probably most importantly, is that the HHS funding continues to change, and we keep receiving additional HHS funding, and so we're looking for opportunities to justify keeping the HHS funding. And so one of the options, because you do have a 24-week period and you've spent way more than your loan amount, is to start to look at those payroll costs that were included in PPP that maybe you can count towards HHS funding. And I think this is really important. So things like hazard pay, things like overtime, if you've documented based on time studies or other hours reports that you've been tracking along the way, whether it's attendance at meetings, dealing with COVID, regulatory issues, time that your staff has spent tracking COVID testing or actually performing the tests for your employees, all of those kind of things can be carved out of the PPP loan, and instead you can count that towards HHS if you think you've spent more than the loan amount. Again, you need to make this adjustment on your application. Otherwise, it appears that you're kind of getting paid twice for the same expenses. A couple tips, just make sure you review the application, really as you create the PPP tracking model so that you don't have to kind of recreate the wheel. The instruction and applications of have a lot of information on the safe harbors. They can definitely help you with that. Certainly review the certifications and representations just to make sure you're not including something that you shouldn't be. Definitely reach out to your bank, because, the banks ultimately are the arbiters in terms of deciding, what qualifies, what doesn't qualify, how the forgiveness calculation works. So, reach out to them. A lot of times they're not going to tell you too much, but they also have, portals and other information you can use to kind of play with and see how the forgiveness calculation works. And I would take a look at the Worksheet A with the full application, Schedule A worksheet. It's not part of the application, but it's something that banks will probably ask you for, and there's a lot more to it than just what goes on the application. A couple things to avoid, mistakes that we've seen. Payroll must be payroll. Can't be a contracted service where you're paying another company who's paying the employee. It has to actually be your payroll. Failure to consider the safe harbors. Insurance costs, we've seen this with a number of clients where they're just basically taking the paid premiums, and it should be the net premiums. In other words, the premium that the employer is paying after deducting the employee portion of the health insurance that's withheld from their pay. Related party rents. This was a relatively recent FAQ, and it's just an example of how you have to stay on top of the FAQs. Initially, we were thinking they would count in full, those rents, and then later SBA clarified it, said you can't count the related party rent, but you can count the mortgage interest that the PropCo actually paid during the covered period. Taking salaries above the $100,000 limit, and basically that's $15,385 for an 8-week period, $46,154 for the 24-week period. And then, the $100,000 limit is just for payroll. You don't need to make any kind of pro rata disallowance for benefits, for example. Okay, the simplified application and that's for loans that are less than $50,000. So most healthcare organizations are not going to have loans of less than $50,000, but you might have, a smaller affiliate, someone else that applied that has this small loan. This is a great deal. Basically, they're saying if you spent the whole amount, if you spent more than $50,000 on covered costs, then you don't have to worry about your FTE quotient. You don't have to do anything else. Basically, it's a very, very simple form, and it's basically just putting in a couple numbers, putting in the amount of your loan, the amount that you spent, you sign it, you send it in, and you're really good. And it's like an automatic approval process. And as I mentioned earlier, 3.6 million of the loans that were actually given out were for under $50,000, and so this really relieves the burden for banks in particular, as well as these smaller companies that have PPP applications. The full or the easy application, obviously the easy application is simpler. It's a 2-page application, but basically you have to meet the criteria, which is basically that you didn't reduce salary or hourly rate for any employee by 25% or more, and that you didn't reduce the number of hours or FTEs of your employees, or you met safe harbor number 1, which is the regulatory issue with the level of business activity. So, we've had some nursing homes that have kind of looked at this. They feel pretty comfortable, using the easy application. I don't see anything wrong with it. I think if you qualify for safe harbor number 1, I'd say, you should go for it. And so the benefits, only 8 lines. It takes the FTE quotient out of the picture because you're basically saying it doesn't apply to you. So you don't report any FTEs. Again, that doesn't mean you shouldn't keep all that information in case you're audited or for some reason at some point safe harbor number 1 doesn't work for you. So I would still do all the calculations, keep all the information, but use the easy application if you think you can. Just a couple, other things to kind of be aware of, things that are included in the documentation. The 10-month deadline is really important. You should keep all of these canceled checks. There's a lot of stuff that you have to include in the application. It's kind of cumbersome at the full application, but you'd still probably need that backup regardless. And the certification, I think, is something to take a look at well ahead of time. Make sure you're comfortable. Make sure you don't see anything in the certification that changes your understanding of the program. But this is what you're going to be certifying to or someone in your organization, so you should be aware of it. So the lender has 60 days after the date they receive it to pass it on to SBA. I think most lenders have been kind of saying, yep, we've received it, it's looking good. They probably will give you the, okay that it looks good, before they pass it on to the SBA. Some lenders may not want to tell you anything. So it's something, if I were you, I would ask them. One of the big questions that we're having from a number of our for-profit clients is the taxability of PPP. And again, I think from looking at the attendee list that, most organizations that are on this webinar are nonprofits, so this is probably not an issue for you. But for the for-profits, I think it's important, just because the IRS did issue this guidance that basically said that, the actual forgiveness is not taxable, but the expenses associated with the amounts that they receive forgiven loan forgiveness on would not be deductible. So essentially it makes the loan forgiveness taxable to them. This was kind of surprising. I think the CARES Act specifically identified this issue and felt that it wasn't taxable to the borrowers, a loan forgiveness. So our tax team has kind of looked at it. We feel that the IRS notice is actually fairly weak authoritative guidance. I mean, you'd think it wouldn't be, but based on the references of that guidance and congressional intent and the applicability of certain provisions that they rely on as part of that notice are not that strong. So we feel, depending on your risk tolerance as a for-profit operator, that you may have a case for treating the PPP loan as non-taxable. A couple things to be aware of is timing becomes an issue if you're an accrual basis taxpayer. If you've if you're looking at maybe taking this particular position, going on extension makes sense. If you're a cash basis taxpayer, we're concerned if you apply early and you receive forgiveness early, theoretically it might be taxable in 2020. So we're generally recommending that most of our clients kind of hold off on the application. And then other thing that's a tax issue is just the deferral of payroll taxes and the timing of when you pay that. And if you're an accrual-based taxpayer, theoretically you could have to the end of 2021, but you wouldn't be able to deduct the payroll taxes that have been deferred. Okay, round 3, PPP 3.0, it may actually happen. A lot of the proposals that have come through Congress have talked as a minimum of maybe putting back up the $134 billion that was unspent. That's a real possibility. I think that probably will happen. But in addition, it might be additional funding and the program expanded, and hopefully healthcare organizations would be able to participate in that, because obviously the rules would change. I think we'll know better at the end of this week whether it's going to happen before the election or before, the presidential results are finalized and who we know is in office as president. So keep your eye on that. COVID testing, there's been a part of the whole, both the congressional package as well as the Republican includes funding for COVID testing, which again would be very helpful for the healthcare industry. But also there's additional funding, especially in the Democratic proposals for state and local government, schools, et cetera, extensions of unemployment, stimulus checks, Part 2, which I know a lot of individuals would be interested in, and then obviously rent relief and student loan relief as well. Okay, I will open it up for any PPP questions that anyone might have. And again, just submit them through the chat line. So if there's anything at all, we're going to have like a brief FAQ right now, but again, if something doesn't come to mind right now, you can certainly, we can follow up at the end as well. We'll be getting to the other presentations, and at the end of each presentation, there's going to be a little time to ask questions on that presentation. With PPP, I'm happy to answer questions at the end as well. Okay, I don't see any questions right now, but again, I'm happy to answer them afterwards. I'm going to turn the presentation now over to Margaret Lally, who's going to talk about the HHS Provider Relief Funds.
Hi, I'm Margaret Lally. I'm a manager here at Bonadio, and we're going to go over kind of a brief overview of the Provider Relief Fund, and then we're going to talk about the Phase 3 application, which has a due date coming up shortly, as well as the reporting requirements and guidance that have been released. So as part of the CARES Act, which Rob said was signed back in March, they created a $175 billion Provider Relief Fund. I think everyone kind of agrees that healthcare providers got hit especially hard. Your revenues took a hit where patients might not have wanted to take care of non-emergent cases. Occupancy has been down in nursing homes and elective surgeries have been down. So revenue has really gone down, and at the same time, your expenses have increased with mandated testing, PPE, which, we all know here in New York was hard to come by, and therefore the prices went up. So, and then on top of that, unemployment has created an increase in the number of uninsured. So I think HHS recognized early on that, maintaining our delivery capacity was very important to combating the virus, and so they really wanted to infuse a lot of cash quickly. As we get into the weeds kind of in the reporting requirements, I did think it was important to put these last two bullets up. These are from the very beginning of the program and kind of describe the spirit and intent. So sometimes when we're looking at expenses, we get very detailed, and sometimes it's nice to circle back to these 2 points and just take a high-level look to see if what you're looking at qualifies. So providers must have provided diagnosis, testing, or care for actual or possible COVID patients. And HHS broadly considers all people possible COVID patients. Obviously, even if you aren't treating anyone, you still have to have that PPE. You still have to be taking proactive measures to keep everybody safe. And then the payments can be used to prevent, prepare for, or respond to the coronavirus, and reimburse for healthcare-related expenses and lost revenues attributable to coronavirus. That lost revenue is going to be important later on because the definition of that has significantly changed since the beginning of the program. So next slide. This kind of gives you an overview of all the different distributions that have been made to date. I think most people on the conference are long-term care providers, so you probably received an initial payment back in April that should have been equal to approximately 6.2% of your Medicare reimbursement. You then received a second payment to true that up to a total of 2% of all net patient revenue. And this happened a couple different ways. If you were a cost report filer, they automatically direct deposited that amount to you. And if you weren't a cost report filer, or if you filed a low utilization report, you would have to fill out an application in order to get that second payment. Then in June, there was a second phase of this general distribution that targeted more Medicaid and CHIP providers. However, later on, the eligibility was expanded to anybody in phase 1 who missed that June deadline, as well as assisted living facilities and a couple other different types of providers. Additionally, HHS provided targeted distributions to providers that were hit especially hard. So there were some specific monies for hospitals that had a certain number of COVID admissions, safety net hospitals, critical access facilities, that kind of thing. And skilled nursing facilities also received a couple of these targeted distributions. The first one happened in May, and it would have been $50,000 plus $2,500 per bed. And then there was a second fund in August. You should have received a payment of $10,000 plus $1,450 for bed. And that was directed specifically for infection control. There's also been a performance-based distribution for nursing homes, and that is about $500 million per month for September through December. And there's some metrics that you have to achieve to show that you're containing infection rates. Your infection rates are good in comparison to the county that you're in, and also that you're minimizing mortality in your facility. It's important to note that they're not going to hold it against you if you get COVID positive admissions from a hospital in that calculation. So you're not going to be penalized for that. And then the last phase that was just announced pretty recently is the general distribution phase 3. There's kind of two pieces to this distribution. First, they want to make sure that every healthcare provider who hasn't yet received 2% of their net patient revenue gets that amount. So if you rejected money in the past, or if you had been limited maybe by, in phase 1, there was a limitation for lost revenue from March and April, all of those kind of limitations have been removed, and you should be able to receive the balance of 2%. After that piece of the distribution is finished, once the portal closes on November 6th, they're going to take whatever money's remaining, and they're going to look at your revenues and your expenses that you're going to report in the portal, and they're going to proportionally allocate those among all the remaining providers in what they're calling an add-on payment. They're not giving specific guidance on the methodology, just that they're going to take those things into consideration. So we're not really sure, but we do think it's important for everybody to apply. I don't think there's any risk in applying, but certainly with everything changing so frequently, you'd hate to not apply and then lose out on it. So that deadline again is November 6th. So pretty recently, they came out with guidelines. We've been waiting for these for a long time. They were supposed to be out in August, and they kept delaying them. And to be totally honest, they're not exhaustive. They provide more guidance than we had before, but there's really a lot of muddy waters still in terms of, real specific questions. So I'm going to go over what we know right now. As Rob said earlier, if there's one thing that has been consistent with all of these funds, it's that there have been changes. Different advocacy has definitely resulted in positive change for providers. And so, this information that I'm saying right now is correct at this point, but like I said, things can change, and we have an election coming up, so who knows what kind of wrenches that's going to throw into everything. But the guidelines for now indicate that you're able to use the money for two separate things. Expenses attributable to coronavirus that are not reimbursed or obligated to be reimbursed from another source. And that would include, your insurance payments, patient payments, funds you receive from state and local governments. And again, that money must be used to treat confirmed or suspected cases, prepare for possible or actual cases. And then this last piece is kind of new, and it is maintaining healthcare delivery capacity. So I like to think about the expenses in kind of two categories. And in fact, the reporting requirements are going to ask you to identify them in two separate categories. At high level, I think the coronavirus-related expenses can be looked at as your variable costs for treating the coronavirus. And then that maintaining delivery capacity piece, I think the intention is kind of to look at those fixed costs that you can't change. So your mortgage payments, your utilities, things like that, that you're not able to flex down with your volumes flexing, but in order to stay operational, you have to pay those. So all of those kinds of things would qualify. And then lost revenues. This is the big change from what previous guidance had been. In all of the previous applications, they had defined lost revenue as the change in revenue either from the prior year or from budget. And they were only looking at the revenue piece. Now they define lost revenue as your change in net income from 2019. So you're no longer able to use budgeted numbers. And if you flexed your expenses down along with your revenues, the benefit to you is not going to be as great. Again, this is a significant change. It wasn't expected. There's currently a lot of advocacy going on from associations. On one of our calls the other day, I know Chuck Schumer and a couple of the other representatives from New York have already reached out to HHS and indicated that, you know, this is really unfavorable treatment and we weren't expecting it, and, you know, hoping to get that changed. So we'll see what happens on that. They also, in this new guidance, kind of more clearly defined operating revenues from patient care and operating expenses from patient care. I think one of the things that's been difficult about this HHS money is the fact that they're really trying to address disparate types of healthcare providers with this kind of one-size-fits-all application. So some of the terminology isn't necessarily consistent across providers, and it's been difficult sometimes to understand what exactly they're looking for. So this phase 3 application actually kind of defined these better. And they're looking to start with your gross revenue, and then you're going to remove your contractual allowances, any bad debt and charity adjustments that you may make. 340B pharmacy revenue is includable as patient care revenue, but other pharmacy revenue is not. You can't include things like that might appear on your either other operating income or non-operating income lines. So things like interest, things like rental income from space that you rent out to some unrelated entity. Those are not includable. But resident fees for assisted living and nursing homes are includable as patient revenue. As far as the operating expenses from patient care, these really kind of have broadened. So they're looking at the operating expenses related, you know, directly related to delivery, and then anything that they say that is generally considered part of an overhead structure. So for all of you cost report filers, you know, I kind of look at it as everything that is reimbursable for cost reporting purposes. So again, excludes costs that you incur on properties that you rent out and other non-operating expenses. So when you're looking at your funds that you've received to determine whether there's going to be a payback necessary, the calculation kind of follows this 3 steps. First, you're going to identify your expenses that are attributable to coronavirus that are not reimbursed by another source. So these would be things like your PPE, your hazard pay for employees, all of those COVID-specific expenses. The second step of the equation is to calculate the change in your patient care margin or net income between 2020 and 2019. So you can't just look at your income statement necessarily, because you are going to want to carve out those pieces of income and expense that are not related to patient care. And you'll get your change in margin, and then they're limiting your lost revenue to that change in margin less the expenses identified in step 1. So this really does kind of reduce the amount that's allowable for the Provider Relief Fund from what we had originally thought. And on the next slide, I'm going to go through a couple examples so that you can see. So the first example we have, provider had $1 million in patient care revenue and $500,000 in expense in 2019, leading to a net income of $500,000. In 2020, you can see that their revenue went down by half, but their expenses also increased. So their margin was actually negative $500,000, leading to a change in margin of $1 million. So they identified $500,000 of COVID expenses, and we take that change in margin and remove those COVID expenses, and therefore they have $500,000 of lost revenue that's allowable for the Provider Relief Fund. Second example, again, their patient care revenue went down by $500,000, but here maybe they flexed their expenses, and their expenses went down by $100,000. So their change in margin was negative $400,000. Now, since they had a negative margin in 2019, they're actually limited to a zero gain in 2020. So you can see here they have $500,000 of COVID expenses. And because their net income in 2020 was negative $500,000, they're limited just to those COVID expenses, and they have no lost revenue that they can claim. So this slide kind of outlines what the reporting requirements are going to be depending on how much money you received. So if you got less than $10,000, you're off the hook. There's no reporting required, and you know, you can just keep the money. I highly doubt anybody on this webinar is in that situation. So if you have less than $500,000, you have aggregated expense reporting. So in the next couple of slides, we're going to look at the breakdown of what expenses they're considering. And in this under $500,000 range, you only have to report the top line numbers. If you got more than $500,000, there is detailed expense reporting, which we'll go over. And if you got more than $750,000, you're also subject to single audit. Kelly will be talking more about that, but I know that for a lot of our for-profit providers, this might be something that you haven't been through before. So it'll be good to, you know, reach out and get a handle on what you're going to need for that. So these are the things that you're going to have to report. I will caveat this by saying there's not clear guidance on what kind of supporting documentation is going to be required yet, and we don't know, you know, how significant audits will be. So I would encourage everybody to document. The more documentation you have, the safer you are. If you don't need it, then, you know, I guess you've wasted a little time, but you'd hate to not have it if there are significant supporting documentation requirements and audit requirements. So the expenses attributable to coronavirus are split into two main categories, and if you received less than $500,000, you only have to report those two categories. So the two categories are general and admin expenses, and then the healthcare related expenses. So under general and admin, these are what I had discussed earlier, kind of your fixed costs. So your mortgage, rent, insurance, lease payments, utilities, your personnel costs, fringe benefits, and other, which they say here is, you know, costs generally considered part of the overhead structure. So, you know, general and admin costs, these are kind of everything, everything but the kitchen sink here. And then on the next slide, we've got these expenses attributable to coronavirus. And these are your actual healthcare related expenses. So your PPE, your hand sanitizer, any equipment that you had to buy to deal with COVID. So ventilators, updates to your HVAC system, IT infrastructure. You know, if you had to expand telehealth offerings, or if you needed increased bandwidth to help people work from home, electronic health record licensing fees, those kinds of things could be included here. Facilities, those would be, you know, actual changes you made to your facility, maybe modifications to encourage social distancing, those kinds of things. So those are the two main categories, healthcare related expenses and then your general and administrative. And these, the breakdowns that I provided are what they're going to ask for if you have that detailed reporting requirement. So in addition to those expenses, they also are going to ask for a few other data elements, kind of some demographic information that shouldn't be too difficult. Revenue payer mix, they want to see. They want to see what money you got from other programs. And then they're also looking for some non-financial data. So personnel metrics, they're going to be looking at your total personnel by labor category, so your full-times, your part-times, and your contracted. They're going to be looking at new hires and terminations. For patient metrics, they're going to be looking for total patient visits, total number of admitted patients, and total number of residents. And then for facility metrics, they're looking for your staff bed numbers. Also, if you had a change in ownership, there's a couple extra things they ask about there, you know, the date of the acquisition, that kind of thing. So finally here, we've got some key dates. November 6th is the deadline for that phase 3 application. And I will say, you know, if you need some help with that, feel free to reach out. We're helping several clients prepare those. And it really has turned out to be a great opportunity to kind of look and see where you're at. The phase 3 asks for your first 2 quarters of 2020. So you can kind of look at that 6 months. And then if you have a couple extra months of financial statements ready, internals, it's a good time to look at it all and see, you know, how much COVID expenses you've had, how much lost revenue you've had, and how much money you got. So you can kind of see, you know, have you spent it all? How much do you have left to spend? How does it fit in with your PPP or other grants that you may have gotten. Because it provides a great time. You can use the money all the way through June 30th of 2021 at this point. And so if you're in the position where you have extra funds, it gives you a chance to really strategize about what you're going to do. Are you going to return it? Or maybe there's creative uses for the money that you can come up with that really will help long-term with your operations, but also allow you to spend the money and not have to give it back. Worst case scenario, you give it back and you've gotten an interest-free loan. So the November 6th deadline is for that phase 3 application. And again, we encourage everyone to apply. No harm in applying. And who knows, you might get a good add-on payment. Then January 15th is when that reporting portal opens. And the reporting portal will be to report on all funds that you used in the 2020 calendar year. And it's going to close on February 15th. So you've got about 1 month there to report. They will be doing, HRSA will be doing some webinars between now and then. They're supposed to. So I would definitely encourage everybody to attend those. I'm sure I'll be attending, and I'm sure we'll have, some email blasts summarizing that if you're not able to. And then June 30th, like I said, of 2021 is the deadline to use the funds at this point. That could change. And then if you did have funds that you used in 2021, you'll have to report on those by July 31st. If you didn't use any funds, if you spent them all in 2020, that February deadline is your one and only report, and then you're all set. So at this point, I think we can open it up for some questions. I think we do have a bit of questions here, so I'll see how many I can get to. Okay. So pharmacy revenue does need to be excluded, but not unless it's 340B. So the savings for that you can include. Inpatient pharmacy costs, I think those are definitely part of patient care. When they talk about pharmacy revenue, I think they're talking about if you have a standalone pharmacy in your hospital that maybe, people from the community can come in and fill their prescriptions there. That's the kind of revenue I think they're excluding. Let's see, we've got another, I think that was a couple people asked that. Change in lost revenue, does that apply to phases 1 and 2 and the targeted distributions, or only phase 3? So the change in lost revenue calculation is going to apply to all of the money when you are doing the reporting that in February and next year in terms of what you can use the money for. The only one that does not apply to is the infection control targeted distribution, as well as that performance-based distribution. They've indicated that there's going to be separate reporting requirements for that, but they have not issued those yet. So, hold on for more information on that. Let's see. A lot of pharmacy questions here. I'm hoping I answered them. If I didn't, please, put another one in there and hopefully I can get to it. Let's see. Can provider relief funds be transferred to an affiliated organization? That's a great question. The general distribution funds can be transferred if it's a parent subsidiary kind of relationship. Not targeted funds though. So if you got funds that were directed towards a nursing home, it has to go to that nursing home. Same with the other, the children's hospital, targeted distribution, rural distributions. If it's targeted as a specific type of provider, it has to stay there. But if it's a general distribution, yes, you can. If you're a parent, you can transfer the money to subsidiaries. So a question: if you have to pay it back, is there a penalty? At this point, they've not said that there is, which is why, we kind of feel that there's really no harm in applying. And I think they would have said something if there was going to be a penalty. I think so much of this has been fluid. They've recognized that obviously, you can look at the initial applications where they were asking for March and April lost revenue and kind of get the idea that they thought maybe it was going to be a quick pandemic. And obviously that's not happened. It's expanded and lasted a lot longer than we may have thought at the beginning. So I think they're providing a lot of flexibility. At every step of the game, they've really taken a lot of provider feedback. They've tried to simplify things. So I don't think that there's going to be a penalty. I think that, the intent is to get cash out there, and then later we'll figure out, how much you needed, and then you can return whatever you didn't need. What is the time frame to pay back? So if you did have to pay back the money, you do have all the way through June 30th of next year to spend it. So I would definitely wait. But if you do have to pay it back, I would assume at this point that it would be through that final reporting portal that they're going to come up with. They haven't exactly said. There are ways to return it now through the attestation process, but if you want to wait and see how everything shakes out, I think that they would. I have to imagine that they're going to have a process for that in June or July of next year. So I think that's all the questions for now. And if you have more questions, feel free to ask at the end or reach out. And at this point, I would love to introduce Kelly DeMonte. She's a partner here at Bonadio, and she's going to be discussing how to account for all of this money that's coming in.
Thanks, Margaret. Okay, accounting for all this. This is the fun part. If you're a nerd like us. So the next couple slides has some questions, and I'm going to focus mostly on PPP and HHS, but a lot of the accounting treatment is going to be similar for some of the other types of CARES Act funding, like Medicare advance payments and things like that. So the next two slides say, before you account, ask these questions. And there's a lot of bullets here of all different kinds of funding. And really the reason why I put this on here is because I think sometimes there's multiple people at an organization who are seeking out funds. You may have your development person seeking out grants and funds from foundations and individual donors, and then you may have your finance person tackling the PPP and HHS funding. So it's just good to understand all of the funding that you have, because as Rob indicated earlier, there's this double dipping concept. So I'm going to talk about double dipping a little bit, but I don't want to belabor it because I know Rob talked about it. But almost every single one of the, if not all of them, of these funding sources have very specific provisions saying money cannot be used to cover expenses that's being covered by another funding source. So it really puts a lot of burden on the organization for really tracking the use of each one of these funding streams. So why is double dip a risk? Because claiming the same dollar of expenditure is going to cause the funder to possibly disallow, claw back money, reduce funds. There's a real risk of retroactive revenue reductions. And on the next slide, the last bullet is it presents a risk of overstatement of revenue and understatement of liabilities. So, when Margaret was talking about, well, what happens if we have to pay it back? The reality is that once you go through all of your accounting, you may find that you can't justify some of your expenses and you may need to pay something back. And it's fine. You just need to make sure you're accounting for it appropriately and account for it as a liability and not as recognized revenue, or else you're going to put yourself at risk of having, a prior period adjustment in your next period, or, mismanaging your cash flow projections or your budgeting for the current and next year. So I do want to talk a bit about that. And before you go right to the conclusion of, I can't justify my spending, I'm going to have to pay it back, I really, really suggest if you're at that point to consult with a consultant on it, or really think about some strategies of your different pools of funding, because there are some strategies in bucketing, your expenses to maximize your PPP forgiveness and maximizing your HHS funds, and then weave in some of your other funding to capture some expenses that truly are not covered by some others. So there is some strategy involved, especially with the elongated time periods of being able to use your funds. So I highly consider, if you find yourself in a position of having to pay money back, then maybe get some, help in in looking at it more detailed. So let's get right into the accounting for PPP funds. There's a couple different ways you can account for it. There is going to be some divergence in practice, so I'm going to give you what my opinions are and that are supported by the AICPA best practices. So the most conservative approach and probably the least common approach for not-for-profits is recording it as debt. So it's conservative and it's to be used really, especially if you have some serious concerns about whether or not you're going to meet the forgiveness requirements. So this is a very safe approach. You're just going to record it as debt, and under FASB SC 470, you're going to follow all the letters of that accounting. You're going to record it as debt on your balance sheet. You're going to have, if you have a classified balance sheet, you're going to have the current portion. You're going to have long-term portion. You're going to have a footnote in your statements disclosing terms, 5-year payout, and then you're going to take it off your books when that loan is wholly or partially forgiven and the obligation is legally released. So the pros to that is that it's, super conservative. The cons to it is that when you finally do get it forgiven and you record your revenue for it, it's going to be well past the time that you incur the expenses for it. So there's kind of a matching difference. The most common approach for most not-for-profits who feel like they can expect to fully meet the eligibility requirements, then they're going to record it as a conditional contribution. And then revenue is recognized when the conditions are substantially met. So the barriers to overcome these conditions are numerous for PPP loans, so you do need to understand what those are. So essentially what you're going to be doing is you're going to be recording deferred revenue when you receive the funds, and then recognize the revenue as those barriers have been overcome. So that could be stretched out over, a significant period of time if need be. So for most of the audience is not-for-profit, but for our for-profit folks, GAAP does not really provide specific guidance on accounting for governmental grants. So this could be cause for some diversity in practice. But FASB ASC 105 does allow, when there's specific lack of guidance, to kind of use guidance by analogy. So they recommend you really, the same recognition as a not-for-profit is almost like a conditional promise, or conditional revenue. So same thing, recording it as deferred revenue and recognizing the revenue as it's deemed to be earned, meeting the terms and conditions. So this may be different for some for-profit entities. They may not be accustomed to having these lines of business, lines of revenue, so then there may cause some entities to develop some new accounting policies and procedures. So what's different for HHS versus PPP is that the HHS funds are subject to single audit requirements. So this is many providers are going to find that they now are triggered to need a single audit when they've never had one before, and that means that there's going to be an enhanced internal control compliance requirements. So I'm going to talk about that a little bit. So a single audit is basically an added audit to your normal financial statement audit, whereas the auditor is required to do additional testing and additional reporting with respect to government grants that exceed $750,000. So it's based on expenditures. So it's really to the extent that you've recognized the revenue. So you may have received $1 million in your reporting period, but if you've only recognized or 500,000 of it, then you may fall under the threshold. So really kind of careful accounting is going to be important, and you really need to be doing it now, and really be thinking about these things now. as Margaret mentioned, the reporting requirements for, for the portal for HHS is going to be February 15th. That's not that far past your year-end closing, so that doesn't give you a lot of time. And audit planning is likely happening now, which means you probably are going to have prelim work over the next couple months, and this is when your auditors are going to be asking you a lot of questions. So if you've never had a single audit before, what do you need to do? You need to discuss with your auditor what you have and what you're doing, because your scope of your normal audit engagement will change. And yes, that means probably your audit fees will increase. So that's important to know for budgeting purposes. You will be expected to provide proof of how you spent your dollars and that it was in accordance with the terms and conditions of the funding source. So I put in parentheses compliance testing. You'll be expected to provide documentation related to your internal controls and your controls of how you've ensured that compliance is met. So internal controls over reporting and internal controls over compliance. The reason why I put this wording in here is because your auditors are going to have to issue reports as part of your audit report package that report findings on internal controls over financial reporting. Now, you've always had findings reported to you on internal control over financial reporting. Didn't always make it into your audit report. It was always a separate report in the management letter, but now it's part of your audit report. Also, the auditor will need to report in your audit report any compliance findings, meaning anything that they found that fell outside of the terms and conditions of your funding source. Thirdly, your auditor will need to report on any findings related to your internal controls over compliance. That's why I kind of spelled it out this way, because you're going to be held to these measures. So you probably don't have narratives written on how you're doing all this and a lot of documentation around it, because everybody is flying by the seat of their pants a little bit, because all of this funding is coming fast and furiously. The guidance is changing constantly. So now's the time to kind of really be thinking about what you're doing, how you're tracking, and does it meet your requirements. So what does this mean for you if you've already had a single audit in the past? Maybe you have a HUD mortgage and you've always been subject to a single audit. Basically, everything that I just said on the previous slide still applies, because this is a new program that you've never had audited before, so now it's going to be considered a major program that's required to be audited. So all the questions that your auditor is going to ask you is going to be very specific to this HHS funding. So it's still probably going to be, a little painful, perhaps. I went through the accounting piece of it very quickly because I wanted to leave some time for questions, but we do have a CARES and More accounting team. We have a lot of engagements where we're helping people with their PPP, loan forgiveness, their HHS applications, and reporting with respect to that. So please don't reach out if you need some help. We do have experts that have spent considerable amount of time and effort learning this stuff inside and out. So with that, I will just take a peek and see if we have any further questions in our box here. Margaret, I think this one might be for you. If you receive more HHS funding than can be offset, what is the, maybe you answered that. What's the payback time frame? I think that we've answered all the questions. Will the Medicare advance payments need to be classified as short-term or long-term? It's basically when your due date is. If it's going to be over a year from your financial statement end date, then it's going to be long-term. But really, it's probably going to be mostly like a deferred revenue item. You're going to record your payments as, a liability and then reduce that amount as you submit your Medicare claims. So it may be a little bit, I'm not sure Margaret or Rob, if you know how far out those Medicare advance payments go, but I suspect most of this is going to be short-term. Will we be emailing a copy of the slideshow? I believe that we can. I think that it's available to be downloaded, but I suppose we can email that.
Yeah, my understanding is we will be sending it out, Kelly.
Okay, thanks, Rob.
And, just to go back to that one question regarding the advanced Medicare payments, I mean, it's based on the 25% withhold beginning in probably March or April. I'd say the majority of it will probably end up getting paid by the end of that calendar year. So I think there might be a portion that's non-current, but probably not substantial.
That's what I would have thought too. Thanks, Rob.
Yep.
Margaret, looks like you have one more question on pharmacy revenue.
Let's see. It says, does all pharmacy revenue need to be excluded, including inpatient pharmacy revenue? And should 340B savings be added to revenue for all quarters calculated? So yes, 340B savings are includable as revenue. As far as other pharmacy revenue, this is one of those things where, I don't think HHS maybe knows every industry well enough to think of every little situation that might happen. My thought is that what they're talking about is if you have like an in-house pharmacy at a hospital and people from the community come in and fill prescriptions, that kind of revenue would not be included as patient care. But if you're providing drugs to an inpatient through your pharmacy, I would say that revenue is directly patient care related, and I would think that would definitely be includable. Looks like we've got a question on lost revenue. If a quarter in 2020 is better than the same period in 2019, does it reduce the amount recognized in the previous periods? So as far as using the funds, your lost revenue is going to be cumulative for the whole calendar year. So they're asking for, on the Phase 3 application, they're asking for it by quarter, and I believe in the reporting requirements, they're asking for it by quarter as well. But my understanding is that when you're actually calculating out your COVID-related expenses and your lost revenue, it's going to be for the whole year. So if you had a good quarter, it is going to unfortunately offset a bad quarter.
Okay, I think that does it for questions. So everybody has our contact information. Please don't hesitate to reach out if you have some follow-up questions after the presentation. We will be sending out the slides as well as I think what we'll do is kind of summarize the common questions that we've received as kind of a FAQ and circulate that as well. But thank you all for joining us for our exciting presentation.